You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
All right. Hi, everyone. I'm Karen Timmerman. I'm from Bank of America Securities, and we're very excited to be sponsoring this morning's first panel. The topic is volume forecast. Is 10 billion your bid or offer? And our panelists will be discussing the issues and opportunities that have arisen amidst the ongoing increase in options volumes. Our moderator today is Steve Crutchfield. Steve is the head of business development at Chicago Trading Company, and he will be leading today's discussion. So let's turn it over to Steve and the panelists.
So everybody feel good.
Yeah, half the battle right there, right?
All right, good morning. That music ended a little suddenly there.
Steve, I've got a suggestion.
Yeah, let's hear it.
I'm on the I'm one of the members of the OIC Roundtable, and we were backstage just thinking about how can we maybe get the attendance a little higher for the morning. So my suggestion is going to be next year maybe cancel the 9 a.m. on Wednesday, and then we hold it at the bar at 11 o'clock at night. Packed house.
10 billion your bid or offer.
I don't see anybody shaking their head no.
Everybody's in? Okay.
Nice. Well, good morning, everybody. We've got a great panel here today with several of the giants of the retail industry here, and I'm I guess it's my job to introduce you guys, so I will do that. But great to see everybody here today. There are a bunch of ways I was going to go with that, but I'm just going to move on. So let's start with Chris Larkin, managing director, head of trading and investing for E-Trade. We've got Greg Stevens at the end. Sorry, I went in the wrong order, but Greg is VP at Fidelity Investments, and Joe Mazzola, director of trading and education with Schwab. And I can't think of a better group to discuss today's topic. It's been an incredible run in the options industry over the last handful of years. It's really exciting. We talked a lot yesterday. Henry did his usual excellent job running us through industry trends and numbers, and we've seen and talked about extensively, all of us the last couple of years in the industry, about the phenomenal growth that we've seen, the surge in trading interest that emerged around the time of COVID and thereafter, and the sustained growth that's continued on the back of that. So I think I used the word exciting twice already. It has been exciting, but obviously with that opportunity comes the risks and a little bit the scary part. So I spent a chunk of time a handful of years ago in my career overseeing options markets for an exchange operator, and I remember, this is in the teens, pretty much every day our volumes as an industry were like 15 million. And as I think Henry said yesterday, that was the case for 10 years, 15 years, something like that. There wasn't a lot of growth. There was that spike of growth in the early 2000s with the electronification of markets led by ISE and everything that kind of surrounded that. And then things were just kind of steady state for a while. And now I can't believe our topic, we don't have it up, but our topic, of course, is 10 billion your bid or offer. We were chatting in the back. I mean, maybe we'll ask the question later, but we're well north of that, almost every day.
10 bid.
On an average, 10 bid. Is anyone at 10?
Yeah.
I think we're all probably 10 bid. I mean, it's about 40 million contracts, right? So that's an unbelievable number relative to where we were a couple of years ago. But the part of that of course is a little scary is how do we grow from there, right? We're just going to be, nobody here's complacent, but it's easy to imagine a world where 10 years from now, we're looking back and we're like, wow, that was amazing growth around 2020, 21, but we've been sitting, we've kind of been sitting there since. So So where does the growth follow? So let's jump right into that. There are a lot of ways that we can talk about how to continue to grow the business, and we'll start by focusing on existing products. So we've seen this surge over the last handful of years. Last couple quarters, the numbers have been a little bit flatter. Equity options volume overall bouncing around a little bit. It fell off and then recovered slightly over the last couple of quarters. Where will new customers come from? Or where would you expect to see, or do you hope to see additional volume growth from existing accounts? What are the drivers beyond just adding more expiries and kind of hoping that demand keeps rising? And Greg, let's start with you.
Yeah, thanks, and thanks everyone for jumping in this morning. I think it's an exciting time for the individual investor. I mean, there's never been more momentum behind the options product with new things, coming out, defined, outcome ETFs, to, the additional, the expiries. We're meeting that customer demand. We're meeting that customer demand pretty well. And I think that with some of these new products, there's an opportunity for us to really expand and to get more interest, generated through these products. But, for me, I think that the biggest opportunity probably comes from our existing customer base. We have, over the last couple of years, we've seen demand in our educational, sessions, 38% increase 2 years ago, a 21% increase last year. So there's a lot of demand, and the education just isn't only options. They're working their way through, fundamental technical analysis, really learning, the product before they then get into options. But the demand is there. The customer base, is there as well. And we're doing everything we can in order to meet customers, where they're at and how they want to learn, whether it's short form or something that's a little bit longer, a 30-minute session, on income generation, or an hour-long technical analysis. And so there's demand across the board, for this for this education. And not only are we doing that, but then we're also, improving our products, the tools, from mobile all the way to the desktop. Customers, trade how they want, they learn where they want. And so by meeting that demand, I think that's where, our customer, growth will come from. And there's a huge opportunity within a lot of, equity traders who still, aren't familiar with options. And that's what we're there to do, is to provide more intuitive, better, points of education within those products to help the customers, grow.
Joe, what do you want to add to that?
Yeah, you hit on the education. I think that's a big component. Ever since the merger has started, we've adopted the Schwab network now. We have Schwab coaching. We actually just started doing live and virtual events again. I just came back from one in Phoenix, and people are interested. You can see this here. People are interested in coming back out. They want to do live events. They want to see people in person. And we're 400 or 500 people are coming to each of these events. And I think the key is, as Greg mentioned, you want to build from your own client base first. Of course, everybody wants to expand, right? But that none-to-one. The people that have shares of stock that haven't made that first option trade. We're still seeing a lot of people that are applying for options approval, whether it's level 1, level 2. They want to get involved in learning more about options and adopting option strategies. The education is what's going to drive that. And then I think to a certain extent, it's kind of meeting them where they want to be met, as Greg mentioned, with the products. We have our stacks report that's coming out on Monday. It's basically the Schwab Trading Activity Index. And it talks about, where we see client net buys versus sells in terms of sectors and in terms of single stocks. So, on Monday, look out for that. We'll be publicizing that. But, what I can tell you is just from a trend analysis, you're starting to see clients really want to embrace kind of some of that single stock call buying. It's something that's been happening for a while. It's, we've been talking about skew for a while and kind of how that's been pushing up some of that call skew. So we see that quite a bit. The other thing that it's been interesting really is spread adoption. And I think that with education becomes more of that spread adoption, and I think that's a good trait. That's something that we want to work with clients and teach them how to really do that, especially kind of given the environment that we're in.
It sounds like you guys will be putting out some more data about this soon, which will be interesting. But I'm curious if you can talk about it. Are you seeing more interest shifting toward single names or sector specific ETFs and such as opposed to the broader market, or is that?
Yeah, I would say it's still single. I mean, well, number one, ETFs still dominate the space, right? It still dominates the trading activity. But we're actually seeing a big shift to the single stocks, specifically anything that can promote generative AI, right? Those are in hot demand. I mean, that's nothing new. You guys understand that. But yeah, when we look at those trends, those are the names that continually make the top of our list.
Yeah, and Steve, I think the one thing just to talk about that growth part for the existing clients. So about 30% of our customers are enabled for options, and then there's a smaller portion that actually trade in a given year. So it's a fraction of the 30%. So I think when we talk about the idea of how do you grow the business, I think we all collectively have millions of clients that sit within our particular firms. And that provides a massive opportunity for us to be able to sort of promote and educate the product to particular clients. And we work hard at so about 15 to 20% of our clients in a given year are new to the firm. So they come into the firm, they sign up, they open an account, and they place an option trade. So that's good growth. That's the types of things that we're trying to get as those new clients. And I think another thing that's really that's been happening that I think is a relatively new trend, and what we saw during the meme stock craze. Like during the meme stock craze, by the way, I think we all collectively got so many new accounts from new younger investors. That's a very positive thing, and a lot of them were opening up option accounts. We were doing, I think, 15 times. We opened up 15 times more accounts for options than we do in a given year during that particular that year. So that's a good pool of clients to educate. But for us, some of the things that we do, we're all doing, I think, a really fantastic job of helping clients navigate the particular product. But the good thing is things like Reddit. There's peer-to-peer education that's going on outside of our particular walls. So I think it's really a really positive thing for people to promote. There's really smart people sitting out there that are teaching other people how to actually trade the product. So it's great to be able to have this peer-to-peer social networking environment that's happening. That's going to really help grow the business.
I'm actually 30%. Actually, sounds like a almost surprisingly high number to me. I think that's great. Do you have a sense of the fraction of your clients that are actively trading options, or that trade more than once every so often by some metric?
Yeah, I mean, we have everything like that. Like we don't disclose everything, but like it's just like everything else. I think you've got to, whether they're trading equities, options, or even like a product like futures. It's a relatively small number of clients that are really actively trading these things day in and day out. And you see that like in the different, when you see the markets, in good environments, the breadth of the clients that are trading are really large. And then when things get a little bit more volatile and it's more of an advanced market, it's the ones that are there every single day that just kind of don't go away. They'll trade all day.
It's the complete opposite of floor trading. Like we know when we wanted those volatile days, right? When everybody's like, you can't miss this day. Yeah, you see that as the VIX goes up, there's a negative correlation with trading. Contract size goes down, which makes sense for the retail public. It's not where they should be, leveling up and trading more contracts when there's a higher volatility. But it's something to kind of keep an eye on because we've been in this relatively stable VIX now for basically since the October bottom. I mean, really for 2 years, right? And that's helped with option adoption. That's helped with trading. But it'll be something interesting to keep an eye on as we move into the fall, right? I think that's where a lot of people are expecting volatility to pick back up. We all know why, right?
Right. Yeah, the education aspect is so important too. I mean, not to tell you guys your business, but I'll share a quick anecdote because I think I've used this anecdote like 4 times at this conference over the last decade plus. I have friends, and I'm sure we all have friends who fall into this category who, I'll mention that I'm in options, and they're like, options, that's risky, And then meanwhile, some of these guys will like buy whatever Jim Cramer talked about last night, based on, no research, just like, I don't know, I heard the stock,
Or the levered ETFs, right?
Right, exactly, right. So and actually the person that I think about when I tell that story, I was thinking about him when I told that story 12 years ago or whatever on some panel at OIC, and He still does it, and he still tells me, he's like, well, options? What? They're risky. Like, I try to explain about spreads and how you can, any investment can be speculative, but there's, many protective and insurance-like characteristics, blah, 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 to an options portfolio. But getting that message out sometimes can be hard.
And I think the good news too for our clients is that we're there for them. In those volatile periods, we see them come, to our sessions. We see them ask, for more information, especially when Yuri and Timmer does, a market update. I mean, there's, thousands of people, who are coming to finance. So we're supportive. We help them through those times, and I think that lends itself to just better overall, outcomes, for these customers to understand what needs to be done.
I think right now what we're seeing is education runs the full gamut, right? So you have, we have a show called My First Trade. I mean, literally, that's what it's called, right? It's basically trying to get that, like I said, that none to one, all the way to like Gen X investing, where we're trying to get millennials and Gen X to adopt more into kind of learning more about the system and options as a whole. All the way up to, we have another show called Fast Market, where it's basically earnings trades and things like that, where we're looking at different type of spread strategies. And one of the things that we've been talking about a little bit as we've seen, like I said, that call skew kind of pick up, is just something that is minor, as you mentioned, everybody's buying stocks based upon what Kramer's saying. Why not a stock replacement strategy, right? You got calls bid up like this. Why not buy a call spread as opposed to, carrying, the cash attached with owning those shares. So, these are things that we work a little bit more with more sophisticated investors, but I mean, it's a general idea that I think anybody can adopt.
So let's pivot a little bit and talk about new products. Interested in hearing what you and your customers are excited about in emerging trends. You touched on this a little bit. I went back and reviewed my notes. I last moderated a panel here at OIC in 2021. Was that a virtual conference? 2021? Anyway, that's what I wrote down. It must have been
virtual?
It was virtual?
No, I don't know.
I have no idea. I can't remember. I get them all confused. Yeah. Anyway, at the time, the hot topics here when we talked about new products were defined outcome ETFs, options-linked ETFs, still very relevant and topical. And we also spent a lot of time talking about something called SPACs. Those are still hot, right? You got a lot of... So anyway, Chris, why don't we start with you? What are your clients interested in?
It's kind of a simplistic answer. I think for the health of the market, and also when you think about something new, I think it's critical for the IPO market to be strong. So we have a great product, and we've got this massive product shelf, obviously, that our clients can trade between single stocks all the way through all these broad-based index that they're taking advantage of today. But the IPO market is such a critical part of getting people interested in single stocks. It's always a much more healthier environment when you're seeing new companies come to the market. So I think number one is I think clients always love to see brand new companies. And I think we're coming from a 2-year period where the IPO market has been extremely quiet. There's not been much at all happening, which is a bit unusual. But I think we're sort of feel like we're turning the corner to see more of that. We need more private companies to go public and make sure that we create that environment. So that I think is, from a new product standpoint, is really big. I think the other stuff, I think there's a lot of things that we're talking about from an industry standpoint that are out there. I don't know if there's really massive client demand, but I think we're seeing things around 24/7 trading, like exploring the idea, like, is this a good idea or not a good idea? There's some of that happening on the equity side. And then you've got things like fractional options that are out there as well. There's been a little bit of debate about, are we ready for some type of product like that? So there's a couple things on the fringes that are sort of like new in nature. And then the last wacky thing that I'll probably say is that, like, it feels like, I think a little bit of if you see some of the speculative nature that's been happening in the market and people thinking much more short term, it does feel like there's been efforts out there to try to get the idea of getting sports and financial services together in some capacity. I don't think anybody has nailed it yet, but you feel like there's some energy and some thoughts around how do people sort of bring these two together in some capacity. So I wouldn't be surprised if you start seeing some things like that are going to kind of combine these two industries.
And there was some news recently about, I believe, Susquehanna providing liquidity in markets on event contracts and on Kalshi. And so there's some of these other things that are kind of emerging related to slightly non-traditional derivatives.
Non-traditional, correct.
Joe, what do you think? What are you seeing there?
I was surprised to see the SPAC craze get to the point that it did. I mean, it was, but like anything else, I mean, it's cyclical, right? It disappeared in 2022, it disappeared in 2023, and it made a little bit of a comeback in 2024. So, I think what's interesting from my perspective is I was a little bit surprised that more of the thematic investing didn't get adopted by the clients. I thought that would be something that would be very interesting to say, hey, here's a sector that I'm interested in. We have sector ETFs, but if you can put together different stocks where I can pick and choose the stocks, and that would be easier for. So maybe that's something down the road, the thematic investing that clients will adopt a bit more. But it was interesting to see the SPAC craze, and we'll see if that makes its way back anytime soon. I don't know.
Yeah, not too much to add there.
Yeah.
I think
that, like, just another example. Just I think that they don't exist yet, and we talked about it yesterday quite a bit. Like Bitcoin, obviously the ETFs got approved. That was a pretty monumental event that happened in January of this year to allow these products to trade on the exchange. Hopefully at some point the options will be approved and our clients can trade them. But again, that's another thing where you have an underlying product that just gets added to the actual option product, which helps grow the industry and the interest from other clients. So.
Yeah, I'll comment on that for just a second. This is a topic I feel pretty strongly about too. I think certainly, and you guys know certainly the client space better than I do, but there seems to be a lot of demand out there for the trading of derivatives tied to crypto assets of various flavors. I'm far from a crypto hype guy, but I think it seems reasonably clear that the demand is out there, and I think giving the investing public the opportunity to trade this stuff in a very regulated, appropriate, safe, capital secured way through SEC regulated broker dealers on securities exchanges is a terrific way to provide exposure to the space toward investors. So certainly hope that the industry continues to push collectively for to getting to a space where approval of options on those crypto-linked ETFs is going to be possible.
Yeah.
I do want to ask one topic that you touched on very, very quickly, Chris. You mentioned fractional options. So I'll ask you your thoughts on that quickly. I've heard some buzz on that too. Certainly a handful of years ago, several of us were involved in launching minis. The idea there being notional exposure on a share of Amazon is too high to be able to trade 100 lot. A lot of retail investors are going to be cut out of that. We should list smaller options. SIBO has had some, and I think recently increasing success, if I'm not mistaken, around XSP, which is a smaller size SPX contract. Minis on single names went nowhere. I think there was plenty of blame exchanged at the time for why that wasn't successful. But do you see a future there, and what would make it different this time, if so?
Maybe. I guess that the answer is that it could. I think the issue with anything, it's not just fractional options, but I think like when you start adding these different things on the fringes and it gets a little bit complicated from a client experience of how you find the particular products and how does this trade versus another one trades, I think that was the challenge for the minis. I mean, I remember back in the day, I was a massive proponent for minis, and I really did think they were going to work. And that was highly debated. I remember at the time between market makers and exchanges and the retail firms. And I recall at the time that back for Apple, my pitch was that I think we had 80% of our customers, of our Apple shareholders, held less than 100 shares. Mm-hmm. And I'm like, this just seemed like it was ripe for success. But it didn't, because again, it was just like it was clogging up our option chains, and people didn't understand what they were, and it just kind of fell apart. So if something like this is going to work, I think we're going to have to find an elegant way where it doesn't feel like it's off to the side and not just somehow embedded in there. So it sounds like a good idea, but I just don't know how you operationalize it. Yeah.
Yeah, I think from the fractional side, I mean, it's interesting, comparing those to minis. I mean, minis, like Chris was saying, it was mind share. I mean, what is it? How do I trade it? What's this product? And it's marketing. I mean, can you get the name, the information out there, and then it didn't end up going well, right? But with fractionals, I mean, what I find interesting about them, we'll see what happens, is that it's still the same product. But we see customers putting in baskets, all the time. They want one of these, two of those, 5 of these, and it's hard to do with options. But with this, maybe there's an opportunity there that we can reach a different audience and and get them a little more diversified rather than just all of their money into a single security. So it'll be interesting to see how it goes.
Yeah, I mean, I think you guys covered it both. So the only thing I would add is that, yeah, I mean, I think it's an opportunity for maybe the younger investor who can't afford 100 shares, and yeah, good opportunity for sure.
Yeah, I will certainly confess I was on record as being a big proponent of the minis as well. I thought they would be successful.
Me
and
too.
If you were to go search for me on YouTube, the first thing I think you would find is a video of me saying the minis are going to be great. So that was the one time I was wrong about something.
We'll always have a video of us being wrong on something.
Right.
That's okay. The risk we take.
But it's true. You guys all touched on there's a trade-off between kind of innovation and complexity.
Sure.
And we talk about this all the time. As someone was approaching me recently on creating a new type of index product, and there are questions about, well, what should the multiplier be? And well, it should be 1 because that's more intuitive. No, it should be 100 because that's what everything else is, and you're going to mess up market maker systems. So always trying to navigate that, I appreciate, is difficult as we get into new products. Let's pivot a little bit and talk about everybody's favorite acronym comprising one number and 3 letters, meaning 0DTE. And Chris, I'll ramble for a second, and maybe we'll start with you again. So obviously a big driver of growth in the industry. Been a lot of press about these things. I think maybe that story's calmed down a little bit as everyone has kind of realized that to some extent options are options, and we've always had options with 0 days to expiration. It's just a question of how many days per month do we have these things. But are you seeing that as a driver for ongoing growth, or what are your thoughts there from a client perspective?
Yeah, I mean, you can't ignore the growth. I mean, you separate the two, like you said, you separate the two topics. One is that you got shorter dated options that are 14 days out. That's, I call that sort of one topic, and that's what the product actually is. It's just a shorter term option. And then you got trading on the day of expiration. People call it 0DTE. We just call it trading on the day of expiration. And it is always, from the dawn of time, that day of expiration is always an active day. So that's one. Now you've taken this where you've added additional days where you're increasing the volume. So that's an obvious reason why you're starting to see that. But you can't ignore it. If you go back just about two years ago to where we are today, we're doing double the volume on the expiration days than we were before. 2 years before. So we are seeing a lot, and it's happening a lot. It's the index side that we're seeing it. So, and if you take all the volume, like on the SPX side, it is representing over half of our volume in a given month is happening on that last day of expiration. But you also, it's like with the activity that you're seeing there, this is not just clients. These aren't clients like opening a position in the morning and then closing it in the afternoon. That's not all the behavior. There's a lot of activity of people rolling positions, closing positions out. There's lots of things that are happening on that day, and I think there's this notion that everybody's in there speculating and just opening and closing on that particular day, which is not the truth. That's not what 100% of the volume. Certainly there is volume that's happening there. And I think that the last thing, if you think about it, is like, just because you're seeing explosive growth, that doesn't mean it's a bad product. I mean, that's it's just showing that there's demand for something that's really good. So I think it's been a success story across the board. Most of the volume is happening in SPY, as you can imagine. It's the most popular product for our retail clients, but we have seen an increase in volume, including SPX and some of the other products as well.
Yeah, I would, I touched on spreads a little bit earlier. I'll talk about that a little bit more because I think it's interesting. When we go back, looking back to maybe the October bottom, what we saw is on the spread side, the duration of the trades, there was kind of the inflection point there where we went from 31 plus was kind of middle of the road to that 1 to 7 day expiry really started to take off around that October bottom, and we've seen that expansion continue. I mean, there's really just been a change, right? That inflection point in demand for those 1 to 7s, and in my mind, especially on the spread side, that really started with that bottom. So interesting to see if that continues.
Yeah, I mean, similar story, with us. I mean, we've seen the growth, we've seen spreads, start to become more prevalent, with us, the growth within those. So, it's an interesting product, a meta demand, in the marketplace, and we'll continue to see how, things, work out. I mean, we do a lot of education around this as well, just making sure that customers understand that these shorter, what goes into trading shorter, duration, and helping them understand what decisions have to be made. And I mean, we're good at getting in, and sometimes we're not as good at getting out and managing the risk. And risk not only, from losses, but profits, and making sure that you're doing that. But yeah, similar stories to both of these guys.
Yeah, we brought out a word we haven't used in a long time with retail clients. That's gamma, right? Like when, I remember 15 years ago when I started working in kind of client education, gamma was like the last Greek we ever talked about. Like, Roe, you don't have to worry about that because interest rates are basically, zero for the longest time. And, Roe's starting to pick up a little bit, right? You start to talk about that a little bit, but gamma, I mean, especially on, if the clients are holding through to expiry or if they're holding up to the last couple minutes. And it's been something that we really want to make sure that they're aware of that risk. It has changed. I think it's changed the way that we approach education.
You referenced skew earlier, and I think when we were having our prep call, you talked a little bit about the impact of increased zero-day trading on skew and hedging behaviors. Can you talk about that a little bit? Yeah,
you know what? Where I see it, I mean, like I said, we've all seen vol compression, right? And whether it's the zero DTEs, whether it's the the overwrite products, maybe whether it's just an increase in the belief of the macro economy, right? We've just seen a lot of hedging has just really dissipated. We did see a little bit of a spike at the beginning of April just because of what happened throughout the course of the month. But you look out at, say, the 90-day options at the index level. They're trading in the first decile, right? Basically the bottom 10% of where they've traded over the last 3 years. That 25 delta put is just not in demand right now. People are looking for that upside trade. We're seeing it a lot in the single stocks. I mean, if you were to kind of extrapolate that, look at some of the semiconductor space, look at some of the names that are leading the generative AI push. You're actually seeing kind of negative skew. You're seeing the calls bid above the puts at the 25 delta level. That's just not kind of how we grew up in the business, right? I mean, we grew up with this investment skew that you hedge your downside risk, but I think the biggest issue is that hedging hasn't worked in the last couple of years. Even when the market was down, hedging hasn't worked. So I don't know if that's a zero DTE kind of making that push, but whatever that vol compression is, you can see that corollary into the skew.
Makes sense. I don't know. One of the things I wrote down on my list of questions was just kind of take the temperature of the group on zero-day options as a phenomenon and whether some of the media discussion related to this topic is overblown or not. I think I kind of have a sense for where you guys are all at on that, but any other thoughts or comments on the zero-day topic before we move on? All right, we'll keep going. So we touched earlier on like that, right? I'll ask a question, then I'll say what the answer is going to be, and then we can just skip the question. Let's talk about a little bit broader shifts in client behavior. This was touched on earlier in some of the things that we talked about. But Greg, maybe just starting with you, other broad shifts in the way you're seeing trades coming into market, overall duration of trades that clients are making, anything else that you see that's indicative of larger trends right now?
Yeah, I mean, I think that we've seen the shorter durations take hold, and our client base has shifted a bit. I mean, we over the last 3 or 4 years we've gotten a bit younger, so new entrants coming into the market, which have been really good for us and as an industry as a whole. But we're seeing a bit of that dipping your toes in the water with equities and then moving into options. We've got a basket trade. I mentioned this, and people are coming in and putting $100 in a month and getting it diversified out. And so we're starting to see that trend of customers doing a bit more when they investing, but with the options, then it's that natural progression that we've been seeing, getting into there, understanding what they can do from an income generation and so on. And so I think we mentioned earlier, the strategies that they were using before, zero DTs, they're still using today. They're still but they're able to target those dates that are important to them. Versus just only having to do the monthly. So it's been good all around.
No, I think that is an important concept in that you talk to somebody and say, we want you to hold this position for 30 days until something occurs. And now they understand time decay, right? I mean, initially they're like, oh, okay, well, I'll give myself more time for this to work out. And they're saying, well, why am I paying all this extra premium when I can, look at this as a binary event and I can trade for this binary event? So I think that's probably going to continue. I think you're going to continue to see the duration shorten on these trades as clients and retail clients, they're looking for kind of that event risk or that event type trade.
And that leads directly to another topic I wanted to touch on. And Chris, I'll ask you this first. But right, so talking about shortening duration, avoiding owning unnecessary premium for exposure to a particular event, that kind of goes to the topic of more targeted expiries. We've got more daily expiries that have been added in index and ETF products. We haven't had that in single names. That's been an extensive discussion of topics of discussion on various industry committees over the last year, 2 years. Chris, what's your view on these? Should we be adding daily expiries on singles?
I'll put my camp in I'm on the fence, and I think that's a good position to be right now. Like I'm a very practical person when it comes to any of these particular topics. I'm open to hearing sort of the arguments on both sides. I think a few things I can say. One is that we are, I'll just represent my firm. We are not getting massive demand from clients to trade these everyday expiries in stocks. So that's number one. You might get on the fringes a couple people, but we kind of know. Like in terms of our clients, when they ask, because we can't trade Bitcoin because we're a bank, I get massive demand on clients want to trade Bitcoin, and I can see it and tell you all the data around it. But so we're not getting a lot of demand from the retail side, so that's one. Two is that the risks of doing this are real. I don't need to go through all of them, but one is that the assignment risk that's involved in having an everyday expiry with the news events that happen during the week, whether it's earnings, whether it's a tweet, whatever it is. That is a big risk, and I'm telling you, there will be problems when this happens. It's not a matter if we have a blow up of a customer or a firm or something like that. It's going to be when, and that comes to the headline risk. I think as an industry, we always want to find ways to grow this business responsibly. I'm not saying this is an irresponsible idea. I'm just saying we need to come up with an idea to make sure that we can cover all these particular risks. And we've had a very healthy debate. I think this is one of the few topics that. I would say the retail community there are some people that are pro and there's some people that are sort of heavy con and some people in the middle. So it's been a very healthy debate, which I don't think you see that often. Usually it's like the exchanges and market makers versus the retail community. I think we're kind of...
What? Shocking.
So I think we're coming... The debate is really good. And I think we can come to a conclusion, but I have personally not convinced yet, but I still think that there's a way to do this.
What do you think, Joe?
I would echo those sentiments. I think that there's a lot of back-end work that needs to be done before we think about adopting these single stock zero DTEs. And the bottom line is we'll make the decision that we think is best for our retail clients, and we'll be supportive. But I think we are still a ways off from there.
Greg?
Yeah, I think Joe said it best, and we're going to do what we think is right, for the client. We're going to meet that demand, where they want to see it. But I think Chris, also mentioned the risk profile. We have to address that, because that ill-timed tweet or just earnings. Now, Amazon had a big move, or they did at least last night, and so addressing that before. We just need to be responsible with what we're looking to do, and then we'll make decisions based on that.
Totally makes sense. I'll just say from the market maker standpoint, of course, more products are great, more targeted products, provided that the quote bandwidth and everything is managed appropriately by exchanges and opera and so forth. And I know that's something we've been working on as an industry. Sounds interesting, and giving the ability for retail clients to have a more targeted exposure to an event sounds good. So philosophically, I think I would very much think that this is worth continuing to explore. The concern that I always worry about, and I think you guys have all touched on this in various ways, is we don't typically have earnings on Fridays, so this issue of a big news-driven move occurring on expiry day is much less common in single names today. And I worry very much about the experience of the retail investor who has heard their whole life through the excellent and very important educational work that you guys in your firms are doing and your peers. They've heard that, yeah, you can buy an out-of-the-money call spread and you don't have any risk, right? You're covered. And they go home on a Wednesday and that there's a big news and there's a huge rally in the name, and lo and behold, they're contra-exercised on their short. They wake up the next morning and they lost a ton of money because they didn't exercise their long. And that goes against everything we've ever told these guys about how options are supposed to work, right? So I think unless and until we can solve that problem, there seems to be some hair on this issue.
Right. Yeah. No, agreed.
All right, so yesterday we heard a good amount about AI during the afternoon discussion, but it's an earth-shatteringly important topic, so it's probably worth revisiting. We'll follow up on it for the last couple minutes here this morning. AI has certainly transformed many aspects about how many people work in a lot of ways, but in terms of trading, at least from where I sit, none of it yet seems to be super fundamental. We've come up with lots of making life easier use cases for it at my shop. There was a guy who used to misspell every word in an email, and suddenly he writes like Shakespeare. And like, I think you're using ChatGPT. That's good.
Yeah, really smart.
Right. So that's you also get the. ChatGPT wraps up everything by saying, it's important to remember that, da-da-da. So whenever I see that phrase, I'm like, oh, it's important to remember. Okay, I use ChatGPT. Anyway, but let's talk for a minute or two. Greg, we'll start with you. Are you thinking about, or already seeing ways that AI-driven technology, generative AI and so forth is impacting not just client demand, but the way you guys operate your business?
Yeah, I think, as you pointed out, there's a lot of good discussion, a lot of good energy around, what AI can do for us as a whole. At Fidelity, we've been using it for, quite some time in one form or another. There's new generative, large language models, that are coming, but we focus on, really three things, to better understand our customers, to remove friction points, in that customer experience, and then, just to, and then to drive better efficiencies within our own business. We've used, some good discussion around using large language models in order to provide better, better search results, for our customers. Understanding really what they want, when they ask for an option, they're not getting, a 3-course meal, right? Coming through there. So. We're using it, in those ways, not only for the customer experience, but for our associates, trying to, improve, just, how they get information and better. So being thoughtful about that and, working our way through it.
Yeah. I mentioned when we started the Stacks report, which is a behavioral based, we look at net buys and sells. But the other thing we do is we do a trader survey every quarter. And when we asked the last one of those questions was specifically around generative AI. And are you using it in your decision making? Are you buying stocks that that have at least professed the ability to monetize? And what do you look for going forward with AI? And we had over 2/3 of our respondents, and I think with the poll was around 1,500 people, about 2/3 of our respondents say AI will be a driving force in the investments that they choose in this coming year. So from the retail perspective, clients are at least adopting the idea of it as an investment.
Yeah, and I think so for Morgan Stanley, we are the exclusive financial services partner with OpenAI. We've been partnering them for a very long time, even before people even heard of OpenAI. And we've operationalized quite a bit from our side, mostly on the financial advisor part of the world. And it's really about the efficiency and the workflow that we're focusing on. One is it's helped facilitate conversations with clients in a quick way where they can ask with ChatGPT, you can ask questions within our database of research of asking questions like, what's the price target on Apple? And it'll give you a summarization of what that is and why we believe that price target is with research that's going to be right underneath it. And then you can ask things like, what's your thoughts on India versus China? Which region do you like more? And it'll come back and give you a very intelligent answer. So that's been working extremely well and helping financial advisors have really good conversations. That's ChatGPT. There's 4 components of OpenAI. The second component that we've been working with is called Whisper. Whisper is the recording of conversations that they have with clients. It records the entire conversation. It has the ability to summarize that conversation. So what it does, it changes an FA's role of an author to an editor. So that they're just editing that particular email to make sure that all the information is correct of what they've gathered. That gets put together in a very elegant email, and they can send it out to the client. That's saving financial advisors 30 minutes per call per day. You start adding it up, the efficiencies that they're getting out of that, and it becomes almost like an FA. It's a financial advisor recruitment tool. So when you start talking to FAs and let them know, like, hey, I can actually release more time for you to spend more time with your clients. That's a great thing. So we're just starting that. We have a lot of other things that we're working on, but stuff that we've actually operationalized, and it's been very successful so far.
That actually sounds really cool.
Yeah, it really does. Yeah. Look at that! You nailed it. Right,
I know. Here we are.
Right on the zero.
Exactly out of time. Chris just.
As Chris is talking, I'm watching that countdown. I'm like, wow, you're really going to hit that. That's perfect.
Well, this was a great discussion. One thing I'm certain of is that in 3 years, probably in 1 year, there will be a discussion on this stage at this conference. Well, not this stage, whatever stage we're on at the secret undisclosed location, about the way that AI has started to transform multiple aspects of our business. So I think we all have a lot to be excited about. Thanks for a great discussion this morning. For the record, $10 billion is my bid. Hopefully that's a better call than my enthusiasm about minis 10 years ago. Thanks everyone for listening. Appreciate it.
Thanks.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.